the valuation many times is way higher than what it should be. Now, what are the consequences? Okay, the startups usually get very happy. My valuation on books is 5 crores, but the investor's given me 10 crores. Now, when I get this 10 crore ka valuation, you have to actually ensure that you show that much of work to your second round of investors. Else, they're going to question your ability of reaching this valuation.
Hello, ma'am. Thank you for being here today for our funding series. We are in the part 2 now, and let's start right away.
Thank you so much. Sure.
So let me start by quoting you. You say that fundraising is an art of a negotiation and the math follows.
Correct.
So could you elaborate on this?
So yeah, there's this myth that the first thing that you have to talk about whenever you're in a negotiation is valuation and the numbers and kisko kitna shares milega and all of that. I think even before you reach the valuation stage, and I'm only referring to the first round of funding. Okay, I'm not talking about the follow-up rounds, because the follow-up rounds definitely the valuation's already decided and the process slightly changes. But in the first round of funding, I think people usually feel कि अरे हमको valuation सोच के जाना चाहिए and things like that. तो आप कभी भी valuation सोच के नहीं जा सकते हो. First is that part. Valuation ऊपर या नीचे होता है, and the investor does it looking at how desperate the founder is to get the money. So the higher the desperation, the lesser the valuation. That's the logic. Also, while you're with a VC or an investor, especially if he's a seasoned investor, angel investor, they would know all the tricks of, I wouldn't say, I think manipulating is too harsh a word, but a lot of tricks to confuse you, to actually tell you that how the business is not that great, or how there are a lot of hurdles in the way for you, and how it's going to take a longer time than you anticipated to be in your business pitch, and why, and because of these reasons, why the valuation is not supposed to be X but X minus Y. Basically, that's the strategy that investors usually adopt. And for that, I feel before even coming to the valuation, what is essential, something that I even slightly, very subtly mentioned in the first part, is how well the founder knows his or her own business. Okay, how well he has analyzed the competitors' business, competitors' investment trends, if at all, how well they have analyzed the risks, hurdles, and what strategies they have to resolve those hurdles and to minimize those hurdles. I think if you have bang on answers for those, it's very easy to shut any person questioning your business model, because the point, again, like I said, nobody would be in a position to know more about your business than you. Even an investor might not have spent 4 years, 3 years working on an idea. So a lot of that is dependent, a lot of things that come from investors dependent on popular opinion, on what comes in the paper, or a little bit of Google research, or what their analysts tell them. So I think you should be confident about how your business is, how your market is going to be operated. You should be dead sure and should vouch about everything that you've put in the business pitch. And for this reason, also, one thing that I tell startups and founders is, don't please brag about something that does not exist in your business pitch. Because even if you get an opportunity for a call or a presentation in the investor's office, if you fall on your face with what you've presented and what you actually are, you're losing out on one investor. You will never get that opportunity, even if you repair your flaws and reapply again. Also, this investment community is a very small community. More than small, it's a very closed community. So it does not take a very long time for opinions to pass on. Hence, it is essential that whatever you present, either verbally or through mails in your business pitch or your emails, is something that is true, and not something that you just bragging about to get some eyeballs. So I think if you understand these nuances, the valuation thing and the mathematical part will only follow, and you will get what you want. So before you get on the maths and the shares and the equity part of it, I think it's best that you understand the entire art of fundraising, and then step towards the mathematical aspect.
So the starting point is understanding the nitty-gritty of your own business
Own
model.
business. And it might sound very cliche, but नहीं होता है काफी सारे founders को idea, especially if the founders are into an entity which is not their expertise. So we were just talking to some entrepreneur the other day who was trying to get into legal tech business. He was a engineer trying to get into legal tech, something that is not his domain. So he's dependent on multiple other people to validate. So he's dependent on his lawyers, his extended team, because he's getting into a legal tech, something that is not his expertise. In this cases, your study has to be even deeper, because investors will be reluctant and hesitant to invest in something where it's very easy for the founders to say, "Arey, ye to mereko pata hi nahi tha." So that's the reason why I think analysis of your own business, especially if you don't belong to the domain, is even more important.
Right. And new founders often cannot correctly discern between different types of investors. So we'd like to know that what should the approaches be to different investors, such as angel investors or institutional investors?
So I think Akshita, an investor is an investor. वो 5 लाख डाले या 50 लाख डाले, he's an investor. I think it would be unfair to really to have this demarcation between investors कि ये angel है तो इसको कम seriously लेते हैं, ऐसे नहीं होता है. In fact, angel and investors, smaller investors, are actually betting on you at a stage where even you might not be very sure about your business. So even without seeing that growth trajectory, they're investing in you. So I think they're taking even higher risk with you, and hence I always feel that your responsibility is slightly more to protect the interest of these investors and not just get carried away because there's a VC now investing. So I think first part is this, that don't demarcate between any of your investors. Rather, if you could, even in your eventual rounds of negotiation when you're fundraising with an institutional investor, try to protect maximum rights of investors who've invested in you at a very early stage. Having said that, I think there's no major difference of approach with angel or VCs. The approach could be from their end, the difference of approach could be from their end, and hence that could impact your response style. Because if it's a VC who's investing, the VC will have a very long due diligence process. They will have series of people analyzing your product, a lot of questions coming from multiple people. But with angel, it would just be 1 or 2 people questioning you. Also, the due diligence process could be really lengthy for a VC. For the angel investor will just look at basic stuff, because again, a due diligence is an expensive process. So to have that kind of, I would only spend 1 lakh rupees, 2 lakh rupees on the DD process if I'm investing a substantial amount. If I'm just investing 25 lakhs, why would I spend 1 lakh, 2 lakhs on the DD process? That's why angel investors don't really get into in-depth DD. There are exceptions though, but I'm just giving you the popular process that is followed. So I think the change of difference of approach is because the way these two investors work, the difference in the way these two investors essentially work. Hence, there's a difference of approach. Else, for us, whenever we are approaching any investor, I think we are equally obliged to protect their interest in the maximum way possible.
Correct. So an investor is an investor, like you said. The interest should be protected.
Correct.
So let's talk about valuation, ma'am. How can founders decide on a justifiable valuation without either inflating it or running the risk of undervaluing it?
So technically, Akshita, there's a process in business. However, we have all very intelligently learned to bypass this process of valuation. Usually क्या होता है कि whenever you have to value, you go to a registered valuer and get your business valued. And this valuation is going to be absolutely dependent on your current matrix. Okay, and a little bit of your projections as to what your plans are, how have you started working towards it, and all of that. A registered valuer is somebody who's supposed to be and expected to be absolutely independent of this entire investment process. Okay, he's a third party. He's not supposed to know what valuation you're thinking of or what valuation is the investor thinking to invest money in. It should be completely his analysis of the data that you submit to him. Okay, and that valuation that you get is the genuine valuation that you're supposed to have for your company technically. But what is happening these days is startups पहले अपना valuation decide कर लेते हैं basis on their logic, फिर वो इन्वेस्टर्स के साथ नेगोशिएट करते हैं, फिर थोड़ा बहुत वो बार्गेनिंग प्रोसेस होता है, एंड unfortunately जो valuation that is decided, the startups go and tell the registered valuer, okay, this is the valuation I want you to have, so I want you to give me. So ये जो process है ना, technically even registered valuers ethically not supposed to do this. They're supposed to tell them कि okay, I will only give you the valuation that is derivable from the books, and then you go accordingly. But that's not how it happens, unfortunately. The valuation is pre-decided by the parties. It might be the right way to do it, but on many levels, it's also unethical and a wrong way to proceed. And that's the reason why the valuation many times is way higher than what it should be. Now, what are the consequences? Okay, the startups usually get very happy. Arey, mera valuation on books is 5 crores, but the investor's given me 10 crores. Now, when I get this 10 crore ka valuation, you have to actually ensure that you show that much of work to your second round of investors. Else they're going to question your ability of reaching this valuation. So higher the valuation, more the stress. Higher the valuation, more efforts you have to put in to establish. तो आज के इन्वेस्टर्स ने आपको 10 करोड़ दे दिया, बट अगला इन्वेस्टर अगर पूछेगा 10 करोड़ का तुमने क्या काम किया है, मैं 10 करोड़ नहीं दूंगा, मैं 7 करोड़ दूंगा. So this drop from 10 crores to 7 crores is even more damaging to you for the health of your company, rather than taking a 5 crore valuation earlier initially. So that's the reason why startups, I feel, should not get excited if they're getting a higher valuation without having too much of work, because at the end of the day, the founder knows how much he has worked and what valuation he or she deserves. So I think, you should be realistic, and you should be aware of the fact that if you're going to inflate it above a certain point, it's going to be very difficult for you to justify it with numbers for the next round of funding. So I think it's always best to be very, very pragmatic about your valuation rather than just looking for higher valuations.
Right. And speaking of valuation, what are the drawbacks of severely, inflating the valuation? What can that later do to you?
So, like I said, the down round investment that could be very risky for you. It's not a very nice thing to happen. And hence, there are different ways of raising funds these days to avoid this valuation, heavy valuation drama. You could always go for a convertible structure where you don't need to derive a fixed valuation at the moment. You could derive a valuation at a later stage. You could have a minimum value decided, but your maximum value need not be derived right now. The valuation, you could agree to give the valuer a little bit of discount in the next funding round and things like that too. So there are different ways. You just have to know about them. Your lawyer or CS, whoever's advising you, there's rights issue way, there's rights shares issued by the way of rights issue, where you don't really need to quickly derive your valuation. So अगर आपको ये लगता है कि भाई कहीं पर भी मेरे valuation का problem हो सकता है, या I am probably inflating too much than what I should, it's always better to raise money in these alternate ways rather than to stick to the normal private placement equity way, I feel. Yeah.
Right. And besides valuation, term sheets are a very important part of the funding phase.
Mm-hmm.
So, how should founders correctly assess and evaluate the term sheet to avoid bearing consequences of ambiguity or multiple interpretations in the future?
Mm-hmm. So basically, usually term sheet is taken very lightly. First thing that we should know is that the investor is somebody who sends you the term sheet. Many times founders ही भेज देते हैं investors को term sheet. तो term sheet is supposed to come from them because term sheet essentially captures the terms of investment. Sorry, the terms on which the investor is going to invest the money, the rights that the investor is looking for. So it's always get it from the best to get it from the horse's mouth rather than we sending our term sheet. Maybe we are giving them way too much than what even they're expecting, right? So a term sheet technically is a non-binding document. It's just a kind of an icebreaker between for the conversation and negotiation to start with. But if you agree to something on the term sheet and you backtrack from it when you're actually executing a definitive agreement, that could be a problem. Hence, even if it's not a binding document, you may be at a risk of losing your investment if you do not read and understand the terms of a term sheet properly. Term sheet usually will be a summary of the definitive agreement that you're going to sign. A definitive agreement that is executed after the investment, which is also known as the share holding and share subscription agreement, is a very detailed 60, 65, 70 pager document. Okay, and the summary of this document is the term sheet. So you're not supposed to take it lightly because it majorly covers the obligations that the founder has towards the investor. You have to ensure that you're not agreeing to give out any such right, which is one, contradicting with the rights that you want to reserve as a founder, which is contradicting with the rights that you've already agreed to some other set of investors, or three, it's actually taking away it's taking away too much from you in terms of futuristic commitments, something that you cannot vouch for at this point of time. So for example, a very standard thing that comes in a term sheet is IPO in a certain point of time. So 5 years में IPO करके देंगे, ये commitment आप आज नहीं दे सकते हो. If 5 years में आपका merger हो जाएगा, ये commitment आप नहीं दे सकते हो. This is a very bad thing to do and put it on paper because nobody knows. So companies, if you look at IPO, they don't go IPO so easily. They have to have at least a 12, 15 years of good run, very good revenue, have to show profits for certain years. And then so if not profits, but good revenue for getting into IPO. So IPO is not that easy. Also, there are a lot of term sheets which say, okay, these rights will be protected, those rights will be protected. If you give those rights to the investors today, will your next round of investors be comfortable? This is also what you have to look at. Is this term sheet going to scare the next round of investors away? If yes, it's best to say a no to this kind of term sheets. Hence, every word in the term sheet has to be evaluated in the best possible manner. And you agree to it only when it does not negatively affect the future of your company.
Right.
Yeah.
Additionally, what are some of the key elements that founders should be very well versed with to be in a better negotiating position?
In the term sheet?
Yeah. Right.
Or generally?
In the term sheet.
So term sheet basically is one is the voting rights that you are giving to the founder, the exit plan that you may be sharing, any other conditions after getting the money in. So condition preceding the funding, condition subsequent to the funding. So what are these conditions? Are these just the compliance aspect of it, or there are some other expectations that the investor has? Reserved matters, which essentially mean the things that you cannot do without taking investors' approval. So if there are things like operations of the company or administration of the company, these are very day-to-day things. You cannot be going to investor and taking investor approvals from time to time just to operate a company. So you have to renegotiate this with your investor. So जब भी term sheet investors से आती है, it is very broad. You have to narrow it down, because naturally the investor is going to ensure that all his or her maximum rights are protected, but you and your lawyer should be smart enough to tone this down and yet not disappoint the investor. So if you're taking away, so usually when we negotiate with investors, we have a kitty of bags, goodies already ready. तो अगर हम दो चीजें निकालते हैं तो ये goodie में से एक चीज उनको दे देते हैं. So that, you know, that thing you should always have, that escrow account should always be ready, where you know कि ठीक है ये नहीं तो हम ये चीज दे सकते हैं अगर हम ये मांगते हैं. Because if you just keep on taking things away without giving anything, then again that's not a good deal, because you have to get those things deleted, still ensure that the investment comes in and it happens on terms that is favorable to you and the company and the investors that are going to come after the investment, after this investment, or investors are already there in your company. So you should exactly know what to give and what not to give. I think that's essential.
It has to be a win-win situation.
Yeah, it has to be a win-win. It's very rarely a win-win situation. There are going to be some rights that the investor is going to take, but then I think it's okay. You don't need to snatch away all the rights from the investor, as long as it is happening in the right manner. So for example, if there are 6 investors that you're talking to for a particular round, instead of giving 6 voting rights, you can suggest them to have, you know, come together as a group, and they could have a group right, or one person who would have the right representing all of them. Because if there are 6 people in the group, it's going to get very, very messy and very dominating. So there are these ways and methods how you could, you know, give them alternates and protect their interests at the same time.
Right. We often talk about scouting and cracking deals, but what should startups know that, and when should startups know that they should walk away from a deal? How can they navigate the technicalities and understand if a certain deal does not serve them?
So I think you should be very well aware of, so these things are going to be very much standard. Okay. So you should be aware as to where and how at a particular stage can the investor take undue advantage of you. So for every round of funding, these things change. So, at a very early stage, the investor might not be worried about how the exit plan is going to be. He might be worried about the board seat. But when you go for the second, third round, he might be extremely careful about how the exit plan is going to be. So the priorities change depending on which round of funding it is. So I think the startup founder needs to exactly know as to what and where could the investor catch him, on what point could he catch him, and those are the things where you have to be prepared for. Hence usually we suggest कि अगर कोई startup first time investor है, first time fundraise कर रहा है, he might as well take help of a company, professional negotiators who will negotiate on their behalf with the investor. Because usually what happens is there's a team of 8-10 people sitting on behalf of the investor. So these are also some tricks that are played by the investment team कि 8-10 लोग बैठे हैं तो वो pressure create हो जाता है, आप बस अकेले या अपने किसी colleague के साथ गए हो. So they put you in a very hard position. The venue is decided by them. You tend to lose your cool and agree to something that you shouldn't. And you never wanted to give away. And when you come back and step out of the conference, अरे ये क्या मैंने कर दिया? So you need somebody who is not directly related to you, who can be rational, who will not lose his or her cool in times, testing times. These professional companies also come with their own team. So if there are 5 people from the investor side, this team also will come with 3-4 people. They'll have an analyst, they'll have a lawyer, they'll have a CS to structure, they'll have a person who's negotiating. So ये सारी team in-house नहीं होती हैं startups के पास. So we usually say कि initially आप इन सारे लोगों का help ले लीजिए. So it's better for you. You don't fumble, you don't give away things that you shouldn't be giving. Especially अगर ऐसा कोई investor है, some influencer kind of an investor जिसको आप follow कर रहे हो बहुत time से, जो somebody who's your idol, somebody you've been looking up to, you've been reading his books, and somebody who's really well informed. Usually VCs के level पे जो बैठे हैं वो इसी तरीके के लोग होते हैं. So you tend to get baffled. So I think for that reasons, you should be very well prepared, have a very good team. If you don't have a team, hire an external team. Know your business model well, walk in with confidence and come out with confidence, and know your term sheet, know your terms. What are they going to ask for? What are their interests in? What can you afford to give? What you cannot afford to give? It's not necessary if you say ki I'm really not keen to give this and I think we should rethink the deal. It's not necessary that the deal cannot be cracked. You're just asking for some time. So it's okay to ask for some time. It is okay to say that I am not happy with giving these things. It's not necessary कि investor की हर चीज आप मानते जाओ. तो ये जो एक composure होता है, I think apart from the business, you should also have that composure for you to get the right kind of a deal. So this is what I feel.
Right, definitely.
Yeah.
And due diligence is a very important part of any funding round.
Correct.
So could you walk us through the due diligence process during funding?
So due diligence process during funding is actually essentially divided into two parts. One is the financial due diligence, which covers your money related matters as to बैंक में कितना पैसा आया, कैसे यूज हुआ, कौन से जगह पे पैसा गया, the money matters. The extension of that fund due diligence is your compliance due diligence, which means if your resolutions, if your EGMs, AGMs, etc. have been taken on time, have your resolutions been passed on time, does your notice agenda, all of that, jo compliance aspect hai, does all of that sync together, has it been, so there are timelines for doing this. So for example, if you have decided to give out away an ESOP, does your AOA articles have an arrangement for ESOP? Has a memorandum, has your resolution to that effect been passed? Are the notices given to the shareholders and other investors on time? Have they been filed with the ROC within that 30 days, 60 days timeline? ये सारी चीजें right from the beginning assessment hota hai, and that is your financial due diligence ka part. Coming to legal due diligence will highly look at your agreements and your liabilities on the document. So for example, you've signed up a vendor's agreement or an advisor's agreement. What is the liability that the company has? If you have a loan agreement, if you've taken debt from somebody, what is the liability? Interest kitna aap de rahe ho? IP, intellectual property ka kya scene hai? Who has the IP? Who owns the IP? So for example, some founders might feel that ये तो बहुत simple है, but we were doing a due diligence जहाँ पे जो domain register होता है ना website का, that was in the founder's name. An investor had held up investment until that domain is transferred to the company, until it is assigned to the company. तो इतनी छोटी चीज है, domain का owner, we might never even think of करे domain ही तो है, but that owning a domain means you can actually make or break the entire website, especially if you're a tech platform. If the domain is owned by a founder says, अरे मैं तो इसको renew नहीं कर रहा, मैं इसको delete कर रहा हूँ, you're done, you're doomed. You'll have to again get a new domain, market it, things like that. You might still have your product, but you've been marketing for 5 years with a certain name, and you again changing the name is not easy. So smallest thing like this is what an investor will look at. If all the IPs, trademarks, etc. are owned by the company, they're not owned by an investor. So ये सारी चीजें हैं in the legal due diligence part, where your contracts and things like that are assessed. And that's the reason why I feel this is not something that you can do in a day or in 2 days. This is a process that has to start right from the time you incorporate. It is impossible. अगर आप इतना time ले लोगे इसको repair करने में, damage control करने में, investor भाग जाएगा. So if you're taking 2 months, because to put all of this place, if you start doing it today and you're running a company for even a year or 2 years, it will at least take you a month, 2 months to align everything, pay off the penalties and things like that if you've not taken care of it right from the beginning. So I think this is something due diligence process internally in the company should start from the day it incorporates. This is not a thing to be kept for the last moment at all. So yeah, so this is what it is.
Great. Thank you so much, ma'am. See you in the third part.
Sure.